Welcome back to The Explainer. Let's jump right in, because today we're unpacking a really highly anticipated earnings report. If you follow the retail space, you know it has been a wild ride these past few years. Well, Designer Brands Incorporated just dropped their Q1 2026 numbers. Now, at first glance, the top-line numbers tell a story of pretty steady progress. But when we start peeling back the layers of this particular onion, we find a surprisingly dynamic shift happening right beneath the surface of this footwear giant. To really get what's going on, we have to look at how leadership is viewing the quarter. CEO Doug Howe had an incredibly optimistic tone on the earnings call. And honestly, this quote right here is the absolute key to understanding the entire report. He said, "Our strong start to the year was underscored by double-digit sales growth in our brand portfolio segment and encouraging stabilization in our retail segment." What's fascinating is the contrast he sets up immediately. He's intentionally pointing us toward two completely different storylines operating inside the exact same company. You've got the explosive growth of their owned brands right alongside the steadying of their traditional retail stores. So here's our roadmap for this explainer. First, we'll hit the big macro numbers for their strong start to 2026. Second, we're breaking those numbers down. Third, we'll look at the brand portfolio boom. Fourth, a little housekeeping regarding topo duty rates. And finally, we'll look ahead to the rest of 2026. All right, part one, a strong start to 2026 and those big headline numbers. First up, overall net sales ticked up by 1.4% compared to the first quarter of last year. In total dollars, that brings their net sales to a very healthy $696.4 million. Now look, in a macro environment where a lot of retailers are frankly struggling just to stay flat, any growth is a win. But as we're going to see, that 1.4%, it's just the tip of the iceberg. Because the real game changer is this number right here, plus 240 basis points of gross margin expansion year over year. What does that actually mean for the business? It means Designer Brands is keeping significantly more profit from every single pair of shoes they sell. Their gross margin jumped from 42.9% last year all the way up to 45.3% this year. And the company is attributing this straight to structural improvements they've been making. We're talking better inventory management, strict pricing discipline, and just much more efficient sourcing. Which brings us right down to the bottom line. Adjusted diluted earnings per share, or EPS, came in at 7 cents. That's a really solid number, and it actually exceeded their own internal expectations for the quarter. So they're definitely starting the year on a highly profitable footing. Moving on to part two, breaking down the numbers. It's really a tale of two segments. If we look at Designer Brands' strategic priorities, you really need to pay attention to the split in their focus. Strategy 2 is all about amplifying their traditional retail side, that core DSW brand. But then look at Strategy 4, building and scaling their owned brand portfolio. These are the brands they actually own outright, like Topo Athletic, Vince Camuto, and Keds. Focusing on both of these distinct avenues at the same time is the absolute core of their corporate identity right now. And just look at the fascinating dynamic this creates. On the retail side, it is the absolute behemoth of the company. It generated $626.6 million in revenue this quarter. That is a massive 84.5% of their total net sales. But then, look over at the brand portfolio. It's way smaller at total dollars, sure, but it is boasting a staggering 19% net sales growth year over year. So you have retail's massive share of total revenue sitting right next to the brand portfolio's massive share of actual growth. It shows you exactly where the momentum is hiding. But hey, we cannot write off the retail side. The data reveals a super important nuance here about retail stabilization. Yes, total comparable sales for the company did dip slightly, down 1.1%. However, foot traffic, the actual physical number of people walking through the doors, improved drastically. They saw a 500 basis point traffic comp improvement compared to just last quarter, Q4 2025. That tells us the physical stores are successfully stopping the bleed and finally getting shoppers back in the aisles. All right, part 3, the brand portfolio boom. Let's dig into where the real growth is. Let's break down how this owned portfolio is just rapidly gobbling up a much larger, much more crucial piece of the financial pie. In Q1, the brand portfolio accounted for 15.5% of total segment net sales. That translates to $114.5 million. And like we said, that's an explosive double-digit growth rate of 19% year over year. I mean, without this specific segment firing on all cylinders, the company's overall top line would look entirely different. And this really puts it into perspective. It brilliantly illustrates how explosive that growth actually is. If we look at operating profit year over year, the retail segment saw a very respectable 28.3% gain. Great. But the brand portfolio, it experienced a staggering 692.5% explosion in operating profit. We're talking a jump from under $2 million last year to over $15 million this quarter. It's honestly a masterclass in how to scale profitable owned brands. Let's pivot for a second to part 4, a little housekeeping regarding Topo duty rates, correcting the past. So you'll often see the phrase immaterial restatement pop up in financial reports, and it can sound scary, but before you panic, let's define it. It is literally just a retroactive correction of a minor financial error. It's something that does not significantly impact the overall financial health or the consolidated statements of the company. So what was the actual error here? Well, the issue centers around Topo Athletic, a brand designer Brands acquired recently. Turns out Topo had been using incorrect duty rates, basically the taxes applied to goods imported into the US. They had been applying the wrong rates to their branded products, both before and right after designer Brands bought them. Let's just look at the math for a second to prove how minor this really is. In the previously reported first quarter of 2025, their total cost of sales was roughly $391.7 million. The adjustment for these incorrect duty rates, just $645,000. Guys, a $645,000 adjustment on nearly $400 million in cost of sales is literally a drop in the bucket. It's the corporate equivalent of finding a missing $20 bill in your winter coat. It's routine housekeeping, it corrects the past, and it absolutely does not change the incredibly strong trajectory the company is on right now. Okay, finally, part 5, looking ahead to 2026. Guidance reaffirmed. First and foremost, they are officially reaffirming their 2026 diluted EPS guidance. They're keeping it locked in between 28 cents and 38 cents per share. But here is the part that should really excite investors. CEO Doug Howe specifically noted on the call that, following this really encouraging start, they believe they can hit the high end of this guidance range. And that's even with all the ongoing uncertainty in the broader macro environment. As for overall revenue, net sales for 2026 are expected to land somewhere between down 1% and up 1%. Now, sure, that's a pretty conservative overall sales guidance, but the entire outlook is heavily supported by the expectation that the brand portfolio is gonna keep booming. That double-digit growth is exactly what they are relying on to offset any lingering softness on the retail side. So we are left with a pretty fascinating dynamic, right? You've got a brand portfolio that is unequivocally booming and retail foot traffic that's just now entering a phase of stabilization. The big question is, can designer brands maintain this high-end momentum through the rest of 2026? Is this dual strategy, managing a massive traditional retail footprint while aggressively scaling highly profitable owned brands, going to pay off over the long haul? It is a serious balancing act, and it requires a lot of precision. We will absolutely be watching their next quarter to see how this plays out. Thanks so much for joining me for this explainer. I hope peeling back the layers on these numbers gave you some great insights, and I'll catch you on the next one.